Hello everyone and welcome to the Geeky Investor where stocks talk and we translate. Today we're going to talk about why the stock market could possibly return 0% annual returns if you invest in the stock market as of right now. We're going to show the data behind that and if that really makes sense or not, so stick till the end of the video. So to begin with, if you see here, over this chart right here. So if you look at the stock market performance, the S&P 500 since the 1994, so over the last 30 years, we can see here that the forward PE of the stock market has been fluctuating with an average of 17.1 over the last 30 years. But if you look here, today's forward PE is around 23, which puts the stock market at a valuation around 30% more expensive as compared to its historical average. And as we can see here, this actually, this number, this forward PE has crossed and reached this high level only 2 times in the past. Once right here, if you look, this is the dot-com bubble in the 2001. And then again, this happened in 2020 when the coronavirus was happening, and I'm sure we've all witnessed that crash. So this maybe signals that the stock market could potentially be very worrisome to invest in at the current levels. Moreover, if you look at the graph right here, so this is the forward PE and the subsequent 5-year annualized returns over the coming 5 years as compared to the historical average. If you look, the higher your forward PE is, the lower your returns. So if you look at a forward PE of 22.9, your returns over the next 5 years is expected to be close to 0 if that is what we expect from the next stock market in the next 5 years as compared to the historical average. Now, would this be a reality or not? We're going to see over time, but we still have other possibilities as we're going to see in 1 second. So here, based on today's forward PE, the expected annual return over the next 5 years is close to 0. So if you look at the Magnificent 7, and if you I'm sure you already know, the Magnificent 7 are these 7 companies. So Apple, Microsoft, Tesla, Meta from Facebook, and Google, Nvidia, and Amazon. These 7 beasts are called the Magnificent 7 because they are the stocks that are hyped, and they make a lot of the valuation of the S&P 500. If you look at the graph right here, so the performance of the Magnificent 7 stocks in the S&P 500. Now, the green line here is the performance in the share price of the Magnificent 7, these 7 big companies, the 7 dogs they call them, as compared to the S&P's 500 companies, excluding these 7 companies, which is the blue line. So the green is the Magnificent 7, the blue is the one without these. And as you can see here from 2021 onward, we can see that the green or the Magnificent 7 has significantly outperformed the remaining 493 companies within the S&P 500. But it's also important to mention that if you look here, the fluctuations within the S&P 500 is more significant in the Magnificent 7. So if you look here, the Magnificent 7 crashed severely at this time when compared to the less of a significant decline in the remaining companies. All right, so the Magnificent 7 are actually lifting the stock market disproportionately because, as you can see here, their growth has accelerated and increased significantly over the past 5 years as compared to the other companies, which is helping lift the stock market. So despite being the largest companies in the world, they still experience large swings, as we've seen here, and at other times in 2022 and 2023. Which is mainly driven by sentiment and expectations. And their share of the total S&P 500 continues to increase, reducing the influence of the rest of the market. Because, these 7 companies are becoming larger, so the others are becoming less influential. Now, on the other side, there is something very interesting. Although we expect 0% almost annual returns over the next 5 years compared to the historical average, there is something interesting to show in this particular chart right here. So I will zoom out just a bit. This is over the last 30 years once again. But what's interesting here, and that we didn't talk about, is the dividend yield. Historically, the average dividend yield is around 2%, while the current dividend yield is just 1.4%, showing that the dividend yield has decreased by a margin of like 30, 50, no, that's less than, around 40% decrease from the prior levels. So this means if your dividend yield is lower, then as an investor, you should expect the share price of the company to outperform or to roughly match the decline in the dividend yield. Because if you're not going to make money from dividends, then you better make money from the share price appreciation, right? So another thing here, if you look at the other chart here, so this is the 10-year Treasury yield. And if you guys want to know what the Treasury yield is, we can see here from Investopedia, Treasury yield is the annual return shown as a percentage that the US government offers to investors who hold its debt, such as bonds or bills. So basically, it's money with the government, which is almost guaranteed to be returned to you as an investor. Now, the 10-year Treasury yields has significantly decreased. If you can see here in the year 2000, the 10-year Treasury yield is 6.2%, while over time, this has significantly decreased to 1.6% in 2022 and almost 4% as of 2025 by the end of 2025, which is showing that, if you're making less money from dividends and you're making less money from Treasury yields, then this only makes sense for an investor to ask for more price returns when it comes to their expected returns. So that's one of the reasons why we could say that the stock market is not really overvalued as much as these historical metrics of the forward PE, saying that, we expect 0%. So these show that some way the stock market performance and the orientation of the investors is changing. Historically, they relied more on the Treasury yield and more on the dividends, while today and currently they are less of factors that investors would rely on. So here, excuse me for that. So here we can see, if you look at this, we can zoom on the graph right here. So look at the green line here and look at the gray line. So the green line is the growth stocks, while the other line is the value stocks. And we can see that from 2019 over all the way to 2026, which is expected, the growth in the earnings of these growth companies is almost always significantly higher than that of the value stocks. So, for example, in 2023 and 2024, the growth in earnings of these growth companies is significantly higher than the growth of earnings in the value stocks, which is showing why these growth stocks, the Magnificent Seven and the other similar companies, since they are growing significantly their earnings, we expect that the share price of these companies to significantly grow, and that explains partially why these valuations, the valuations of these companies, is significantly higher as compared to the historical averages. Now, if you look here on this other side, now you just have to focus on this table right here. So the revenue, we can begin with the margins. So the margins on average of the companies, or the net margin or the earnings net margin on average was 2.2 in the last 20 years, from 2001 all the way into 2024, while the average margins or the earnings margins as of today is almost 6%, showing that these companies are making significantly more money as compared to before. And that's thanks to the AI, thanks to the internet, and the other innovations that these companies have made, which have driven their margins significantly. Additionally, you can see that their revenue growth has also accelerated. As of recently, the revenue growth is around 5.2% as compared to 4.9%, and that makes the total EPS significantly higher, almost 30% or even more, like 40% higher as compared to the historical average. So if you have definitely better margins, you have better revenue growth, you have less dividend yield, and you have less treasury yield and returns. So as an investor, it only makes sense that you ask for more of share price appreciation as compared to the historical averages. So comparing to the historical averages is not like really you're comparing an apple to an apple, right? I believe you can appreciate that. Now, this is also an interesting chart right here. The S&P's 500 profit margins, if you see, this is from 2002 all the way into 2023 or 2025. So the margins overall, they have significantly increased from almost 8% to around 14% profit margins, which shows that the companies as of today are making much more money as compared to the companies historically. So at the end, what we can see here, if you look at the chart right here, I know today's video is all about charts, but it also makes sense because it's really educational and shows data. So as we can see here, the green line is the top 10 companies, their earnings and their market cap. So it is the weight of the top 10 companies in the S&P 500 as a percent of market capitalization over the last 12 months, over the last 30 years. So if you see, their earnings has significantly increased, these top 10 companies. So for example, these magnificent 7 companies or the top 10 companies within the S&P 500 over the last 30 years, their earnings has significantly increased and their market cap has significantly or has really followed that increase in the earnings. So that's why the higher the earnings, the higher the market capitalizations and the share price gains. All right, and here we can see over the right side, if you look at the Magnificent Seven. So you guys remember these Magnificent Seven, right? So here, sorry, excuse me for that. The Magnificent Seven, if you look here, these 7 companies, their margins, their earnings, their growth has significantly outperformed the earnings and the growth of their peers, the remaining 493 other companies, and have outperformed the historical averages of the companies over the last 30 years. So if you look here, the earnings growth year over year for these Magnificent 7 companies is in green. If you look here, the growth in earnings for these companies are almost always significantly higher as compared to these other companies. And the same goes for this chart from all the way 1996 all the way into 2025, showing that the top 10 companies are making much more money. All right, so in conclusion, let me know what you guys think. Is it that over the next 5 years we expect on average to make 0% money in the stock market? Or do you expect, or do you think that the companies here are different as compared to the last 20 or 30 years, and these valuation metrics don't make much sense or don't have to be as the same baseline or average as compared to the last 30 years? Thank you, and I see you in the next video.